I hope you're planning to join us if you're in Calgary or the environment. Hey, you could drive down from Edmonton 2 weeks tomorrow, October 27th in Calgary. By the way, it's a free event, but there's also a VIP ticket that you have to purchase, and Jack Crooks is going to be there, Victor Adair, myself, talking about how to make money in the incredible currency gyrations has never been easier because of the exchange-traded fund market and others. Jack's going to give you his step-by-step guide. And if you remember, Jack was with us at the Outlook Conference early February, and boy, he's just had a terrific year. But the volatility is what makes it a really incredible opportunity that you should come and just learn about. Make a commitment to your finances, very much in the way Lance Roberts does, who's the host of Street Talks Live, but he's the chief editor of the X Report that looks at economic, political, market topics, and I'm so pleased to welcome him back to the show. Lance, thanks for taking the time on the weekend.
Absolutely, my pleasure.
Now, I mean, there's no shortage of stuff for you to be talking about. I know you've been busy on CNN, NBC, and Fox and stuff like that, but come on. Has it been a little bit overdone? Are we just becoming too fixated in the investment markets on events like what we've just seen with the budget drama?
Sure, absolutely. In fact, I'm just sitting here writing our weekend newsletter as we sit here and speak. And, it's one thing I've been talking about now for the last couple of weeks is that if we go back and look at history in terms of government shutdowns, this was the 18th government shutdown that there's been throughout the history of the United States. The average drawdown, the average fall of the S&P 500 during any of those shutdowns is 0.52%, less than half of 1%. So, we're all fixated on this government shutdown and the antics that are involved in Washington, but in reality, the markets historically haven't cared. And in particular, now where you have the Federal Reserve pumping in $85 billion a month in liquidity, the markets really don't care. And we've been in a strong bullish trend in the markets, and that's been telling you that there's not really too much concern by the financial markets as to what Washington's doing, but it certainly makes for good headlines and conversation.
And a great point that you're juxtaposing that, because, I mean, again, I don't know if it's the media that, so powerful and so omnipresent that, they sort of get fashion trends, and one of the fashion would be to look at this budget. Before that, it's to look at the Federal Reserve, but the Federal Reserve stuff is by far the more important.
Oh, absolutely. By no stretch of the imagination, what is going on with the Federal Reserve, and of course, the recent kind of nomination of Janet Yellen brings a whole new dynamic to this issue because, if you thought Ben Bernanke was dovish in terms of, putting money into the markets and providing quantitative easing and keeping easy monetary policy in place, he's going to look like a hawk compared to Janet Yellen. She's going to keep the foot on the accelerator for quite some time, and that's going to be very bullish for the markets in the near term. Now, I want everybody to understand there is a risk that is building here. Historically, when you inflate asset markets to a point, and we are in the process of potentially creating the next asset bubble, you've got to be aware that regardless of monetary policy, eventually the ride comes to an end. And this doesn't last forever, but in the meantime, it certainly provides an upward bias towards the markets.
So you're not seeing also, then, Lance, you're not seeing tapering is in the offing at all.
Not right now. And let me. The reason is, and I wrote about this a few weeks ago, before the actual government shutdown started, is that the reason that the Federal Reserve did not taper their bond purchases in September was the same reason that the Federal Reserve launched quantitative easing 3.5, however you want to call it, in December of 2012, is because at that point they were worried about the effects of the fiscal cliff. Remember, the world was going to end because of the sequester, and all these spending cuts were just going to drive the economy into the ground. And we said back then it was not really that big of a deal because these $1 trillion worth of cuts were spread between 10,000 different sub-agencies. And of course, it turned out it was a very negligible effect. And all the liquidity sent stocks rallying 20% for the year. The reason they didn't taper in September was because of the debt ceiling debate and government shutdown. They wanted to make sure they didn't extract support at a time where markets could be facing some turmoil because of Washington antics. Well, that turned out to be very prescient. It worked well. The problem now going forward is that we now have a lot of excess liquidity built up into the markets. And so if there is a deal reached in the next couple of days with government, expect markets to surge towards probably 1750 to 1800 by the end of this year because of the excess liquidity that's been built up during this process of this government shutdown. But the underlying economics are not improving, and that's going to keep the Fed injecting capital into the markets for an extended period of time. I don't see a taper anytime before 2014.
And so, again, for everyone listening, no pressure on interest rates to go up, but the same scenario unfolding in Canada. It's quite amazing, though, Lance. Every time, like all the revisions in the economic growth scenarios are downward. I mean, I can't even keep track of the number of times they have to revise and say, oh, no, it's not going to be quite that good. And it doesn't matter if we're talking Europe or the States or Canada.
Sure. And you do realize they have to do that. The problem for the Federal Reserve, and I keep saying I write about this stuff because I wrote about this earlier this year. Every time the Federal Reserve, and basically that's every central bank in the world, they come out and they say, well, for 2013, we expect 4% economic growth. Well, if they came out and told you that, really, guys, the economy doesn't look great here, so, I'm not sure what's going to happen this year, the markets would tank. I mean, we would be in a major bear market before you would know it. So they have to come out and they have to kind of guide the markets down. Because they come out and they take market expectations and they match that expectation at the first of the year, and then they begin to slowly guide those expectations down towards the end of the year. And I actually run this analysis every quarter when the Fed releases their projections. I run the analysis and show this downward trend, and you see it both in earnings expectations as well as economic expectations. It's always high at the beginning of the year, and we tailor down towards the end of the year. But this is what keeps market participants from, freaking out.
Let me just come back for a second, Lance, to the next drama in Washington is going to be the debt ceiling debate. And again, I was making this comment much earlier today when I was getting interviewed and just saying, man, the number of people who don't get that there's two separate issues going on. One was the budgetary stuff, which was, in my opinion, completely manufactured politically. And then you go to the debt ceiling and, related, of course it's related, it's politics, but, a different issue. But a lot of talk about default, and I would have put the probability of default at this point, at basically zero.
Absolutely. There is no risk of default. Now, let me say that with one caveat, okay, is that there are sufficient government revenues coming in to pay our interest service on our debt. And now the one caveat is in the month of November, this is kind of the interest payments are lumpy. But in November, there is a very large rollover of debt. It's about $400 billion in debt that has to be rolled over. So there is an abnormally high interest service payment that has to be paid in the month of November. However, the reality of default comes down to a choice that is made by the executive branch not to pay those interest payments. We can prioritize payments. We can do other types of things. We can even delay payments temporarily. Now, while that's a technical default, the real issue of default of not paying our debt at all is an entirely different issue. But that is what is floated out to the average American to basically use fear-mongering to put pressure on their congressmen and senators to reach a budget deal that may or may not actually be in their best interest.
I'm talking with Lance Roberts. And now, look, you can find him. I want to give you the address because it's a new web address, stawealth.com, stawealth.com. Lance Roberts, he's host of Street Talk Live, but he's the chief editor of the X Report. We'll talk more with Lance. I'm going to come back and say, okay, what about the markets then? This is the backdrop that we've been dealing with, especially in the media. So what do you do specifically yourselves, the kind of things that you should put front and center? And we'll do that with Lance Roberts when we come back right across the Chorus Radio Network. With us coming up, I've got my shocking stats of the week. Also, I've got a very serious goofy that I think should concern every one of us. All of that coming your way. And a reminder, by the way, again, October 27th, that's 2 weeks Sunday, we're going to do something that I have not done in Calgary, but Jack Crooks, I'm getting him up from Florida. And we're going to talk about, and Victor Adair is going to come from Vancouver. We're going to talk about how to make money in currencies, and especially with the advent of exchange-traded funds it's also a great seminar in the do's and don'ts of how to trade. And as I say, Jack's had a terrific year here. You hear Victor every week on Money Talks. This is something that you want to get into. www.moneytalks.net. And during the day, we have a whole raft of free seminars with a great lineup of people. So mark that down. That's in Calgary. Come down from Edmonton, too. I'd love to see you. But in Calgary, October 27th, Sunday. Right now on the line with me, I've got Lance Roberts. Lance is CEO of Street Talk Advisors. You can find him at stawealth.com. Lance, we just talked about and set up sort of the environment we've all been reading and hearing about. I want to talk about what does a trader do with that environment, and what does an investor do, or what significance for investors?
Well, when we talk about investors versus traders, we have to really talk about time frames and mentality in many ways. And this is something that's very near and dear to my heart, by the way. As individuals, we have our 401k plans, we have our portfolios with our advisors, et cetera, and we tend to think of ourselves as investors. Oh, we're an investor. I'm a long-term investor. The reality is that we're all pretty much moving towards being traders more than we are being investors. And I say that because if you take a look at the statistics of average holding periods for investments, in 1980, that was 6 years. Today, it's less than 6 months. So in other words, the average investor, they don't hold things for very long. They tend to do exactly the opposite. And you know this. We've all heard these stories that investors tend to buy at the top and they tend to sell at the bottom. And if you take a look at money flows just this year, for the first time since 2008, when we were going through the financial crisis, this year was the first year that there's been a real big surge in investors buying equity-based mutual funds. Here we are 5 years into the cyclical bull market, and they're just now starting to buy equity-based mutual funds, kind of ad nauseum. And what this means is that now these individuals are potentially buying very close to a peak in the market, and they're going to wind up selling potentially after the next correction. So as a trader, what I have to focus on is very, very short-term movements in the market. As an investor, I really have to understand what the fundamentals of the markets are and then buy that accordingly. So this is very important to understand the difference. So let's talk about traders for just a quick second. As a trader, I'm only worried about the short-term movements of the market for the most part. Fundamentals don't matter as much to me as a trader as it does being a long-term investor. As a trader, I'm looking at daily and weekly trends of the markets. Are we positive or are we negative? And this recent move up in the market since the beginning of this year has been very positive. There's been a very defined bullish upward trend in the market. This recent correction that we just had over this whole government shutdown, debt ceiling debate issue actually brought the market down to that bullish trend. We hit it on Wednesday. And we actually wound up buying the market on Wednesday, and on Thursday and Friday we had a big surge coming off of that support line. That is a very favorable environment. That trend has not been broken, and because of all the Fed support for traders, if we get a breakout of the markets on Monday or Tuesday, which I think is highly possible if the deal is reached sometime this weekend, that we could see a very rapid surge in the markets, potentially to 1750, potentially even 1800 by the end of this year. So for traders, this is a very good environment. For investors, not so much.
Well, I love, by the way, the holding periods that you're referring to, because it's been a very difficult buy and hold period because because of the volatility and the intensity of the moves if you're on the wrong side of it. And then, as you say, that intensity seems to prompt people to do the wrong thing. And unfortunately, I'll look in the mirror a little bit on that myself. I'd hate to tell you, Lance, how much money I spent learning that lesson. In fact, I used myself as a contrary indicator for years.
Trust me, that is anybody that has been in this business. I've been doing this for over 27 years altogether, and I have learned all my lessons very much the hard way and very expensively, might I mind you.
Yeah. I've got a tear in my eye as we speak.
Yeah, exactly. And look, anybody that ever tells you that, oh, I never lose money in the market, just trust me, they're lying to you.
Yeah. So let's talk about the investor side of things. Would you sort of sit back? Excuse me. I've had a fighting this cold thing here going on. But, I've been looking, and I've been saying for a while, because I'm sort of got a bullish. I don't see reason not to be bullish, especially as you say with Janet Yellen in there. So I'm looking for opportunities. When we see a good dip for some reason, I've been looking for some quality sort of growth/dividend plays, yield plays that way. I still think over time I'll be okay on that. But would you be setting aside of the market till they sort of sort out this debt ceiling on the short term at least?
In August, so let me talk real quickly about how we manage money at STA Wealth Management, because I think it's very key to this conversation that we're having. As a money manager, I have to navigate two things. I have to navigate the market, and I have to also navigate client psychology. So my clients are calling me up. They're panicking over the debt ceiling, going, "Oh my gosh, the media says we're going to default, and the world's going to come to an end, and we've got to get to cash right now, because if we're not in cash, we're going to get completely toasted." That's their psychology. What's the market telling me? The market telling me that they're not worried about it. The markets are rallying. We're within a bullish trend. I want to be invested in the market. So, my problem is having to negotiate with my clients to keep their emotions in check so that we can allow the markets to do what they're supposed to do. So this is that overlay between how individuals react emotionally to investing versus how you and I have to manage money from a non-emotional basis, strictly looking at what the markets are telling us. We've got to follow the trends in the markets, and we have to manage that accordingly. So yes, I agree with you that I think that we have to be bullish in the short term, simply because that's what the markets are doing. That the markets are telling you they want to go higher at this point because there's all this liquidity that wants to come into the markets. So we've got to set our emotion aside. Now, I said as an investor, though, you've got to be more cautious here. The fundamentals of the markets, let's talk about, trailing valuations. We talk about cash flow. We talk about earning enterprise value versus EBITDA. I mean, if we take a look at many of the valuation metrics of the market, there is a very small universe of investable stocks that still meet those positive fundamental criteria. It's getting more difficult to find these opportunities that are quote unquote cheap. That tells you that we're getting very extended into the markets, and that we're going to eventually have a reversion of these kind of the fantasy, so to speak, which is this liquidity-driven rally, to the realistic fundamentals of what's happening in the market. And those reversions tend to be fairly nasty. But that could take a year. It could take 2 years. I can't tell you when it's going to happen, but that's why we have to pay attention to the direction of the market and let the market tell us when that reversion is beginning to happen, and then react accordingly.
I think absolutely terrific advice. And you can find Lance again at stawealth.com, stawealth.com. He's the CEO of Street Talk Advisors. He's the chief editor of the X Factor. Lance, look, I always appreciate you stop on the weekend after a busy week and take time with us, but terrific stuff.
I appreciate it. Look, anytime I can do it, let me know.
That'd be great stuff. We got to get you up here, too, by the way. Lance Roberts. I'll take a break. I'll come back. I got Ozzie Jurek. Hey, in a mortgage, know someone who needs one? Stay with us. I'm glad you're with us. By the way, I just mentioned earlier about Jack Crooks. Keep in mind at the World Outlook Conference, he was suggested going long the U.S. dollar versus the yen. That trade made 300%. Then in May, he comes out and he talks about shorting the euro, and that made about 90%. Interesting thing is the opportunities with exchange-traded funds. You don't have to be stuck with those kind of things, but he went yen against the British pound, made 95%. So I played the China slow growth story that was out there, and this is what currencies are great for. You got a slow growth in China. How do you play it? Well, he shorted the Australian dollar again using exchange-traded funds, 88% growth there. He's coming to Calgary. He's part of a bigger thing. You buy your VIP ticket. You can go to moneytalks.net. Then there's a whole raft of other speakers that are included in that. So you can come down. There is, as I say, this free portion, but there's a VIP portion that Victor Adair will be there with, and of course Jack Crooks coming up from Florida. So go to moneytalks.net. Just a couple of minutes. I've got my shocking stat of the week, but first, I've got Ozzie Jurek on the line with me right now. Ozzie, I was just thinking, and by the way, because it was a personal issue coming up, getting a mortgage, not for me, but for someone I know. And we've talked at length several times on the show about the fact that excuse me, investors have a tough time getting financing. I mean, and that doesn't seem to have been alleviated at this point.
No, it hasn't. In fact, the Toronto Star, Susan Pig just broke a story showing that on the pre-sale market, mortgage brokers, realtors, and developers have seen a surge of people who bought pre-construction condos 2 or 3 years ago. They're now scrambling to get financing to close the deal. And she says that some buyers had to walk away from the deposits worth tens of thousands, or had to borrow from family or against their principal residence to come up with the final payment.
Yeah. So what happens then? I mean, what advice can we give individuals when it's kind of in that style of a marketplace?
Well, and particularly when you look at, that some of these mortgages were pre-approved, and we always believe, once they're pre-approved, well, then that's okay. But there's really the rubber hits the road, that even if you do have an approval, particularly if it's just a verbal approval, this financial institution may no longer be keen to finance or have new regulations based on the government putting the sums on, and they're saying, well, you have to have more down payment. Instead of 25 to 20%, you need 35, and so on. And so many investors who bought some of those units, they were then shocked to find out that pre-approval don't work.
Yeah, and great point that you're making, because I mean, that's been my experience also, that people come, they've got this pre-approved thing. No, that doesn't guarantee them anything. It's a good thing to still do. Go out and get pre-approved, because if you're getting turned down at that stage, you've got a real problem. Exactly. But there's other things they can do.
And I always say, get it approved in writing, even if your manager is your mother. Make sure you get it in writing. But it looks really that all mortgagees, mortgagors are now being looked over the magnifying glass, particularly the mortgages for the self-employed. I mean, you can have impeccable payment history, good down payment, stellar credit, and still don't get approved, because the banks now, under pressure, are looking at the documented employment income or documented income, which makes it very difficult, not just for pre-approvals or the average investor, but particularly for retirees who have all these stellar credits and all that, and still can't get some of the equity that they have in their properties.
Let me just reiterate, is the biggest side of this problem in these pre-sales, or is it gone right through, and especially, as I say, of concern to us, or in the investment side of things too?
No question. I mean, it's gone right through. It's not the pre-sale was just a coincidence that the Toronto Star writer went and interviewed all the construction industry and the developers and a lot of buyers. It's a good story. We have the link on our website so people can read it. But, the big thing is, when you go get a mortgage, make yourself look as good as you can. It takes more time to shop for the best institution that matches maybe your personal circumstances. You need a good mortgage broker, because they're not all alike.
Yeah, let's go a little bit further with that, about how you can make it. You just said a good mortgage broker. What else can you do to make yourself look good and qualify, in other words?
Well, we teach in our course that you should always have a mortgage binder ready. We always don't wait till the last minute to chop around to where's your purchase document and your tax notice and your strata fees, and particularly the written lease agreements that you have with your tenants, and maybe your employment verification letter, bank statements, all your financials, your income, rental, dividends, and have that in sort of a binder and update it every 6 months. But if you do that, you then arm your mortgage broker with all the facts about your personal situation, and then he can match you to a financial institution. I mean, there are 40 or 50 financial institutions competing for the business, but they want to have, their own rules matched, and a good mortgage broker can do that.
Good stuff. And by the way, you can find this at jurock.com, because this is part of the new reality. And whether you're a first-time buyer, whether you're looking at a pre-approval, whether you're looking at an investment property, you got to do it. It's a business. You got to do it right. And as I say, that's great advice. Ozzy, what about a couple of quick hot properties?
Well, we ran across in Phoenix an older remodel, side-by-side duplex, 1,000 square feet each side, 15,600 income. It's on at 140,000. We had 2 properties in Las Vegas, 3-bedroom, 2-bathroom, 5-year-old home, double garage, 220,000, and a townhouse in Las Vegas, 2-bedroom, 1.5 bath, 89.9. But there is a caveat in Las Vegas, a lot of price reductions, so be very cautious. The market may be changing there.
Okay, we'll keep an eye on it, obviously, here. Ozzy, have a happy Thanksgiving. Appreciate you taking the time.
Thanks for having me, and you also, and the listeners. Happy Thanksgiving.
You can go to www.jurock.com with Ozzy as I say, and some of the details. You always get the hot properties there if you want to have a quick look. Obviously, you got to check what's appropriate for you. He's just Ozzy just is so active looking around North America for things that merit further attention, merit further scrutiny, and that's what he brings to us. He says, here's some interesting stuff. Go do some homework on it. I'll take a break. I'll come back. Victor Adair. I'm going to be interested. What is Victor doing in this market? I don't think what's happened has surprised him, so I want to know if he's active in this. Plus, I'll come back first with my shocking stat of the week, then Victor. Then we still got a goofy for you on the Chorus Radio Network. Hey, reminder also in Calgary, Andrew Rulin's going to be there, Tyler Bullhorn's going to be there, Chad Wazilenkoff and others. Going to be a great day there, Sunday, October 27th. Time now for this week's shocking stats of the week. Well, you probably know, or thereabouts, that we're going to talk about a debt ceiling here. Well, the U.S. government debt is currently at about $16.7 trillion. This is a shock. They got $60 trillion more in unfunded spending promises. So promises they've made, they do not have money for. $60 trillion, a number so big, it is not comprehensible. Then you've got the Federal Reserve. It's going to borrow $1.1 trillion this year. That's about 80% of the overall Canadian economy in a year. They're going to borrow $1.1 trillion to buy bonds. Do you know that $250 billion per month is spent by the U.S. federal government, but it's auto spending. It's not what they're debating in this debt ceiling thing, in the budgetary debate. That's about 80% of U.S. federal spending, $250 billion every month that they don't control, they don't have immediate talk about. Okay, here's the shocker. Which do you think is greater in the United States? Think of all that consumption out there. Which is the bigger, student debt or credit card debt? Well, you probably know it's student debt, $990 billion plus. It is not included in the U.S. government debt statistics, although the U.S. government's on the hook for it. Their default right now is at $146 billion. What's that? That's basically the program spending for the federal government in Canada. That's a huge issue. Not just the individual student debt, but the accumulative debt is not being taken into account. And it's just another reminder of the precarious situation financially for the U.S. Victor Adair joins me on the line, and he will be in Calgary October 27th. Vic, you must love this idea, you and Jack together, to talk about your favorite area, to have a look at, which is currencies. I mean, I was just giving Jack's record this year. He's had a terrific year.
I'm really looking forward to being with Jack. I've been reading his research, and Jack and I talk frequently, going back a number of years. I like the way he looks at the market. I like his approach. And I also like the way he's so humble about, when he gets a whack on the side of the head, too. I mean, I heard you and Lance talking about that. I mean, we all get them. And I think the thing that separates the winners from the losers is you try to keep those whacks to the side of the head relatively small, and then you carry on. It's a marathon, not a sprint.
Yeah, there you go. Well, let's talk about this week in the markets, Vic. I don't think you were surprised by the action. We have been talking back and forth about, when people get optimistic, there's a deal, the markets would rise. When they get pessimistic, the markets will drop. But it's interesting to note, for example, all of the indexes closed at their highs on Friday. And, but there's a lot behind all of that that's not to do with fundamentals. It's to do with just people's attitude about do they want to hold positions.
Absolutely. We had, the market has been consumed here the past 10 days or so with politics as opposed to how it's usually consumed with Fed policy. And we had a real turnaround day on Wednesday. It was interesting. Up to the lows on Wednesday, or I should say down to the lows on Wednesday, the Dow had fallen almost 1,000 points from the highs that it made around the 19th of September. And then that was also the day that Janet Yellen was nominated as Fed chairman. Also on that Wednesday, we had the minutes of the last Fed meeting, the one back on February 18, where the Fed decided to not taper. But we found out that it was a pretty close call. It just about went with that anyway. The market started the rally. It was almost like a stealth rally, and then it really started to burn to the upside on Thursday, closed right on the highest on Friday. It feels like the players in the market, the short-term players, do not want to be short this market going into the weekend just in case there's a political arrangement achieved.
Yeah, just a testimonial to how the market, on the short term at least, is just focused on all the goings on in Washington. If they did reach an agreement, say Sunday, man, they did not want to be playing the market to be going down. But conversely, it looks like from the news, but that could change every hour. But we had Mr. Bonner leave and say, boy, the president's not even negotiating, so that won't be good news. But I think we can expect the market to follow that news cycle.
Absolutely, that's sort of on the short term. The only thing that seems to matter is that the headlines, the rumors and the denials and whatnot coming out of Washington. It's pillar to post. What we've seen impact in other markets, generally here the past couple of weeks, the U.S. dollar has been weak as the market's taken the view that, let's say, Washington doesn't have their house in order. So that's pressured the U.S. dollar. And as you discussed with Robert Levy, even in that environment, gold has been weak as well. The credit markets have been broadly sideways. So, and I'm very much interested to hear what Lance had to say there about the stock market. It really does feel as though the bullish enthusiasm is still there in the market. One of the things I note, Mike, is that the small cap market, and these are smaller stocks as opposed to the big Dow 30. The Dow has been weak relative to the small cap market. The Russell 2000 here is only 1 day away from having new all-time highs again. This is kind of typical at the later, more exuberant stages of a stock rally, but certainly if we get an agreement here in the days ahead, I would assume that we're going to take this market higher.
Yeah, and just a reminder, I also like what Lance said in this way, because the market is moving faster than the fundamentals, the higher we get, it is incurring more risk at that point. At some point, even though I would agree with you and agree with Lance, even though the market looks like it wants to go higher, the risk gets increased because I think it's outstripping the fundamentals behind it. So it becomes more likely to get a correction of some significance going forward.
Well, yeah, as Lance said, the valuation metrics are being stretched.
Yeah.
And it is a function, surely it's a function, of this cash that's being printed by the central banks, not just in the United States, but around the world, that's finding its way into financial assets and boosting prices. The stock market in Germany is touching new all-time highs. We've got a very strong stock market in Japan and other countries around the world. It's not just here.
Very quickly, come back to gold just for a second for me.
Sure. The action in gold, and you and Robert talked about this. We've had 2 days where there was some nasty, big, chunky selling right on the opening of the American market. I know some people could look at that and say, gee, that's part of a conspiracy to push the price down. It also looks to me like that's when the margin clerks would just say, they do their numbers overnight and they say, okay, just sell a couple of thousand first thing in the morning, get it done. That's what margin selling would look like. But whatever it is, we're seeing a decline in the outstanding interest of the gold ETFs. We're seeing a decline in the outstanding open interest on the COMEX. The market, it's a bearish market in gold right now, and it'll be over when it's over. But the June lows that we made, and we had a $230 rally off those June lows, I mean, that's beginning to be in the crosshairs here as this market stays under pressure.
I agree. I just wrote that on the blog just before this. It was a lucky timing thing, but I said 1280, 1180, they're all in play now. And possibly 1040, I think. And we'll see. As we always say, the market will let us know on that one. Victor, I want you to go out and have a terrific Thanksgiving weekend here. Thanks for taking the time. And again, Victor will be with us October 27th in Calgary. Get your VIP ticket for that by just going to moneytalks.net and click on the banner. Victor, happy Thanksgiving.
You too, Mike. Thanks.
I'll take a break. I'll come back. I think this is an important Goofy Award coming up, so stay with us. I'm glad you're with us. Let me get right into this week's Goofy Award. Trevor Zink, he's a former Nova Scotia politician, was sentenced this week to 4 months in jail after pleading guilty to fraud over $5,000 and breach of trust. He accepted reimbursements from the Speaker's office to cover constituency expenses in 2008 and 2009. Hey, but the problem was they weren't incurred. Meanwhile, mentioned this earlier, Detroit Mayor Kwame Kilpatrick sentenced to 28 years in prison, racketeering, conspiracy, fraud, extortion, tax crimes, after years of forcing contractors to pay off an accomplice who then kicked it back to Kilpatrick. By the way, that sounds very much like the broad approach used in Quebec by organized crime as outlined in the corruption hearings. By the way, last count, for me, might be higher now, 109 arrests. My favorite was when they arrested the mayor of Montreal for corruption, replaced him with a guy who's going to come and clean up, the successor, until he was arrested for corruption. There are a few other, by the way, convictions this week of politicians, which all plays into the grand theme of losing lack of confidence in government. But here's the Goofy Award. The award for unethical, self-serving behavior has to go to the Ontario Liberals, and what I think has to be included in any discussion as the most self-serving political move in history, when they canceled 2 power plants for no other reason than it would improve their electoral prospects. Now, it's not unusual. Obviously, political parties of all stripes do stuff to curry favor, but it's the size of this one that makes it way out of bounds. The Auditor General in Ontario reported this week that the cost could be as much as $1.1 billion to $1.5 billion. Think about that. How many hospitals can you build with that? I made a comment earlier this week that you could literally solve homelessness in Toronto with that money. All for their own political self-serving interests and expediency. Now, it's not against the law, by the way, to be self-serving in politics. But here the price tag is just too overwhelming. And by the way, I'm going to give a minor goofy to the NDP and the Conservatives in Ontario. Because instead of bringing down this government, this coalition minority government, instead of bringing it down, and if you're not doing it for this issue, what would you do? Neither party wants an election, so they don't want to force, a confidence vote in the legislature because their parties aren't ready, and that is not in the party's interests, or rather the public's interest. But again, this goofy goes to the Ontario Liberals. $1.1 billion. Wow. I hope people think about that when they keep demanding people pay more in taxes, because there is an obligation of how it's spent, and in this case, outrageous. That's this week's Goofy Award. Remember, go to moneytalks.net, sign up for What Mike's Reading. It's a free service. I send you the best thing I read all week, plus stats and quotes. And also, I hope I see you in Calgary, October 27th. You can sign up there.